Hello everyone, thanks for joining today. In addition to our normal performance update, we've also included a summary of our active trades over the last 18 months and some detail on the impact of tariffs on a number of our companies. As before, the webinar will be led by Jerome Stern and our CIO, Chris Rosbach. After the presentation, we'll turn to Q&A. We've already got some good questions, but please do send more during the call. I'll now hand over to Jerome.
Thank you, Sandy. A warm welcome also from me to our second 2025 WorldStars Global Equity webinar. We look forward to a great update today, especially given the current tumultuous times. We are an investment partnership managing $2 billion of AUM on behalf of institutions, endowments, wealth managers, and families, 20% of which on behalf of my family, providing investors with an unparalleled, powerful alignment. We manage a concentrated numbers of investment strategies on behalf of long-term investors based on fundamental research with a core focus on quality. Our sole mission as a firm is to deliver strong long-term returns on behalf of our investors. Our flagship investment strategy, WorldStars Global Equity, represents $1.7 billion of AUM, of which $375 million in the Luxembourg UCITS fund and another $450 million in a Delaware LP fund available to eligible US investors. WorldStars invests in a concentrated portfolio of quality global companies for the long term. This conviction-led approach leads to a high active share, low turnover portfolio, which has delivered for its clients 10.6% per annum net of fees in US dollars and 12.2% per annum in GBP for the past 10 years. This performance builds on the quality of our investment proposition, the stability of our investment team, the repeatability of its institutional investment process, and WorldStars' available investment capacity. Moving on to how we define quality. Remember, quality is the defining condition for us to invest in the company. Of course, this is going to be a small repetition for many, but I would like to highlight this for the attendees who join us for the first time. We define quality as strong and sustainable competitive position in good and growing industries with companies led by management with a strong track record of value creation and the financial strength to weather any type of adversity. If a company does not display those qualities, we will just not invest. We look at those hard qualitative and quantitative criteria in a disciplined manner, making this the cornerstone of our investment process. Our definition of quality leads us to invest in 4 key buckets. Digital transformation, which represents 44% currently of the strategy. Consumer industries, which represents 19%. Healthcare and life sciences, 16%. And industrials and infrastructure that account for 23% of the strategy. And by the way, we're overweight on both of those last industry buckets. Similarly, our relentless focus on quality makes us avoid balance sheet-driven financials, so banks and insurance companies, regulated businesses like utilities, resource-based industries, and capital-intensive businesses. We want to highlight as well the quality, experience, longevity, diversity, and stability of our investment team, which manages the WorldStars Global Equity strategy. The team is led by Chris Rosbach as portfolio manager and Katerina Kosmopoulou as the deputy PM. The senior members of the equity team are all partners of the firm, thereby strengthening the alignment with our clients. At that stage, I will now hand over to Chris.
Thank you, Jerome, and welcome everybody also to our investment update. There certainly is a lot to talk about. One of our favorite sayings is, micro is what we do, Macro is what we put up with. And we certainly are having to put up with quite a lot. So we want to give you an update on the performance, as well as on some of the drivers that underlie it. We want to talk about the overall situation, the impact that the policies of the President Trump and his administration have been having, and our perspective on what it means for some of our companies, why we think they're going to be resilient, and why we think that the impact that they will have will be moderate in the cases that we anticipate. But I want to start with talking about the performance. As you can see, and as you know, the long-term performance that we've delivered has been very strong. We've been able to generate strong absolute and relative returns over the last 10 years, both in the absolute terms you see, as well as in outperforming the MSCI World. What you can also see, I think, here in the graph is that there are times when we perform strongly and outperform, and there's times when we perform less strongly and when we underperform. But as you can also see here, these periods of underperformance are opportunities, not just because the prices are low and in absolute terms, but also in relative terms. And I think you can see that in the pandemic, we performed strongly and outperformed markets, and we're able to build on that. The performance clearly suffered in the Great Rotation with the spike in inflation post-pandemic and the normalization of interest rates, which did not favor the types of stocks that we've invested in, but that rapidly rebounded, as you can see, and led to a strong performance. And in a very similar way, we're going through a period that is comparable in the third and fourth quarter last year, with the rally that is really the Trump rally related to the expectations that people had for the policies that President Trump was going to put in place that favored some things, and I'll show some detail about it. And now clearly the issues that we're having around his overall policies, but in particular the tariffs. The issue is that we can deliver this strong absolute and relative performance with resilience in periods of adversity, which gives us confidence in the integrity of what we do, in the quality, importantly, of the companies that we invest in, but also in their prospects for value generation going forward. So what you can see here is that after a strong start to the year, including outperformance over the MSCI World, we ended the first quarter down 3.5% versus down 1.8% for the market. So I think given the upheavals that we're having in aggregate, a resilient type of performance, both for us and for the market, but clearly some underperformance, due obviously to the uncertainty around the tariffs that President Trump and his administration are putting in place, and two, because the questions on the impact of those tariffs on growth in the economy and on the growth prospects of our companies, because clearly no matter what happens, and we'll go into some of the framework that we're using to put that into perspective, clearly there is going to be some impact from the uncertainty in terms of corporates investing and spending, and consumers spending and potentially saving. So with that, let's just move on, and I want to discuss briefly this the active return, factor return, and selection effect in overall terms before going into some details on Q1 and on the last 12 months. We invest in companies, not in markets. Stock selection is what we do. So this is a chart that, as many of you know, we look at on a monthly basis to see what is driving the returns and what stock selection is doing compared to the factor exposure that we have. And that factor exposure we take knowingly. It comes out of the quality approach. It comes out of the types of companies we favor compared to the ones that we disfavor, as Jerome just highlighted. And what you can see is that the returns have been driven entirely by stock selection over the period since the beginning of 2020. So basically the whole period from the pandemic. What you can see also is that as you look at the pink line, without going through some of the past periods that we've discussed, if we just focus on the period in 2024-25, you can see how effectively the active return starts to decline and in particular how the pink line, which is the factor return, declines. And that's what I was just alluding to. That is the fact that we avoid banks and insurance companies because we think they're getting disrupted. We think that effectively they're utilities. If every deposit in the US is insured in one form or another by the US government, if not by the FDIC, and other types of businesses, utilities and others that are generally potentially favored by the declining interest environment that we've been in. So you can see the factor return there declining and then flatlining. And you can also see the selection effect, very importantly, through that period being stable. It's now declined somewhat in these relatively modest type of reactions that we've had on a year-to-date basis that I think are related to short-term reactions to what is going on with the tariffs and the impacts that they may have. But I think the overall picture, again, I think is very strong. And one of the things that this analysis allows us to do is to focus on the areas where there are issues, to identify them in terms of the stocks, do more work, and then decide what to do about them, which we, of course, do as part of our active investment process. If we just move ahead and now talk about the first quarter of 2025, I just want to show you a couple of pieces of information to put into perspective what's happened, because of course behind the overall relative resilience of the overall stock market, as well as our portfolio, there are some much more significant moves. And I think what's clear in terms of the performance and the relative performance is that it's very closely related to the sector exposure that we have, which of course is related to the factors. And again, we don't like insurance companies and banks, and you can see the strong performance here in terms of banks. You can also see the strong performance in terms of energy that had a positive contribution that we will see how long-lived that is. I think we're seeing some of the reactions already to what is going on and to some of the changes to the tariff regime that are being put in place. But you can see where some of these issues are. You can also see the fact that technology has had a significant impact, although there you can see that while communication services is down and we have much greater exposure to that, you can see that actually our exposure to the broader technology industry with much greater cyclicality that has been hit quite hard as there's been a reversal after years of strong performance. You can see that we're actually actively underweight compared to the MSCI World. And so that therefore the contribution, while we've of course had some stocks that have been related to that as well, most of all NVIDIA, you can see that from a relative perspective, it's actually a balanced impact in terms of the first quarter. If we just move forward then to look at the attribution analysis for the first quarter, it's a similar perspective. It just splits it into the selection and the allocation effect that has been impacting it. You can see a number of patterns. If we focus first on the allocation effect, that's the pink line here, you can just see another perspective on energies, on financials, and on utilities, where there's been this effectively allocation effect that has impacted us because of the relative performance of those sectors during the first quarter. You can also see that healthcare has actually been a notable positive. And I think that we have been very keen on companies like Roche, like Alcon. EssilorLuxottica, the leader in lenses and sunglasses, is also qualified under GICS in healthcare. It is what it is. These are stocks that we've had positions in and that we have been very positive about and that have been a strong contributor. So I think as you look at our portfolio and you recognize the diversity of drivers, including these allocations that Jerome alluded to at the beginning, then you can see how they help our portfolio to be resilient and to have effectively the keel that allows us to sail closer to the wind at times in terms of also having exposure to higher growth companies. So I think that's something to highlight, and we'll see that in a moment as well. If you look at the selection effect, first of all, you can see that's also been very positive selection. So that's very good to see, and we're happy with it. Real estate is American Tower. That is, it's one of the world's largest REITs. So that's also positive, and you see that's in particular a selection effect issue that we're very happy to see. You see it information technology, which that is clearly in part related to NVIDIA, but you also have it in the case of some of the companies that have performed very strongly, like Alphabet and Eaton, but also in the consumer staples that continue to struggle, even though we think that they are at very attractive valuations. If we move forward to look at what that means just in terms of some of the stocks, briefly, you can see here the benefit of this diversification that we have. We've grouped it by the colors in these overall areas of underlying drivers that we classify our portfolio in, but we've also given you the names for the top 5 and bottom 5 performers here, and it really highlights what I've just said. You see Nestle, you see Roche, you see American Tower, you see Abbott, you see Essilor. These are companies that in some cases have been some of the laggards over the past period, and so it's very good to see them performing, and quite strongly in dollar terms. So we're very happy to see that. And you can see likewise on the bottom, the cluster around in particular what we classify as digital transformation, which is tech and communication services, among other things. And that's where clearly profits have been taken, where in some cases there's been concern around antitrust and around tariff, as in NVIDIA. We'll get into that. But I think that gives you a strong sense of what has been going on in the portfolio and how the diversity of what we have has allowed us to generate the returns from having some of the right stocks in the higher growth areas, but also having positions in some of the more compounding type growth companies that are benefiting the portfolio right now. If we move forward now, just to touch on the 1-year trailing performance, which I think is relative, then the pattern is, of course, somewhat similar. Again, you can see here that it's on the one hand financials that have performed very strongly, and it's in particular also utilities, which are areas that we look to avoid for the reasons of quality. But you can also see here that it's consumer staples that have been among the detractors given our strong positions in those areas. But again, we've just seen that already some of them have been beneficiaries have been beneficial to the portfolio already. They've started to perform, and we're very happy to see that. And as you can also see here, the communication services and other areas have been in aggregate positive contributors to what we've been doing. If we look forward then again in the same format at the attribution and selection effect, you see very similar patterns. You can see actually the strong positive selection in healthcare, which again is, I think, very positive and diversifying for us. And you can see here some of the issues that we've been facing on this rolling basis that we are that have been leading us to both double down work, as well as some of the fact that some of the trading that we've done in the fourth quarter has been correct to reduce for valuation reasons some of these positions. But I think you see again the financials, but in particular, I think one of the issues is you can also see the consumer staples, which again is related to what I was saying. It has cost us in terms of the exposure, but we think that it is an area, first of all, where there's tremendous valuation, and secondly, where we will benefit from the different drivers, as indeed we're doing already in the first quarter of this year. And so, John, just again, to wrap up on the 1-year rolling, you can see here that some of the stocks and some of the pattern is the same, but it's very good to see RTX, which is the industrial and defense company, doing as well. We've said that investing in these kinds of companies is entirely compatible with our approach of looking at companies that have a high degree of quality and that are making opportunities of the challenges that we're facing. And we think RTX is one of them. It has performed very strongly, even though it's more in the middle of the companies on a quarter-to-date basis, and you can absolutely here see an actually very different pattern over the trailing 12 months, where you can see it's much more clustered around the consumer products companies that have hurt us. That's what you saw on the previous slide in terms of the allocation effect. But of course, some of these have started to perform, and we think that they're going to be positive contributors going forward. So I think that's one thing, and I think and just to give a brief update as far as April goes, clearly with the announcement of the tariffs and the beginning of the implementation, and frankly, starting to see how this is going to shake out, the markets have declined. The MSCI World, as of yesterday, was down 4.1%. Our portfolio was down 6.4%. So, excuse me, that's for the year. Let me rephrase, sorry. Start again. For the year, down 4.1%, and for the year, down 6.4%. Month to date, our estimate is that the MSCI is down 2.4%, and we're down 3.1%. So just to be clear, so we have continued to, I think, in aggregate, be resilient given the significant uncertainty, but the somewhat relative underperformance has continued on a month-to-date basis. I hope these numbers are clear, but I can reiterate them if we wish. So that's what I wanted to say about the performance. And if we now look at the longer term perspective, I just want to wrap up really this part by saying that when you look at these periods, we very strongly believe the quality will prevail, that we will get through these issues. And if you look at the performance of the World Stars Global Equity Strategy in terms of the 5-month rolling periods that we've showed you here, we've been able to outperform in the vast majority of those rolling periods over the last 10 years. So just again, highlighting, I think, the opportunities that come from periods of setback. And if we move forward just briefly in terms of the positioning as we stand right now, if you look at it by these different areas in terms of the active weights by GICS, by country of listing, and by stock, you can see that by the sectors, it's remained very, very consistent. I think conservative and in the right place to take advantage of the opportunities. By listing, it's actually interesting to see that relative to the MSCI World, we're overweight Western Europe, we're actually underweight North America. So from that perspective, to the extent that some of these shifts that are happening are going to be with us, we're rightly positioned for companies to take advantage of some of the positives that will come out of this over time in the US, but especially in Europe. So I think that is good to see. And I think if you look at it on a by stock basis, you can again see with Eaton and Amphenol being among our top active overweights, you can again see that we have the offsets for some of the digital stocks that we continue to have a high degree of conviction in. Then just briefly talking about some of the active trades that we've done over the past period, and in particular in the fourth quarter of last year. We've grouped it here again by the areas to give you a sense of what that is. And as you can see, we've been able to act out of a position of strength. We've been selling in the light blue parts of positions in digital transformation, NVIDIA, 3 times for portfolio management reasons, and a 4th time in the fourth quarter of last year out of portfolio management and risk reasons, but also out of a recognition of valuations and opportunities that we saw elsewhere in our portfolio and in the stocks on our approved list that we wanted to add. And you can see that we've been reallocating that capital into areas where we've seen value. We've been buying more industrials, in particular, we've been buying more consumer stocks. That hasn't been right so far, but we think that it will. And we certainly, I think, are consistent in terms of the conviction that drives us. We also reallocated one of the stocks in healthcare to Zoetis, the leader in animal health, which we're very positive of. You can see that stock coming in. And we used the reduction in these stocks, which included a number of the digital companies, to buy a position in ICE, which certainly has been successful so far. It's the platform that we highlighted the last time. At one point this year, it was up 14%. I think it's still up about 4 or 5. So I think we're quite happy with that and think that it'll be a beneficiary of what is going on as it unfolds. So with that, I want to conclude the discussion of the performance and the drivers, as well as some of the trades and the positioning of the portfolio. And I want to shift our conversation to, I think, what is the clear area of greatest concern, which is the geopolitics and the macroeconomics that we have to put up with. And it's clearly about President Trump and his administration and the policies that he's been putting in place. I think it's very important for us to keep perspective on this. The elections in the US, in my personal view, are decided on economics, and what people vote for is a stable economy and lower prices after the dislocations and issues that we've had over the last couple of years. They've gone against incumbents, and I think they went against the incumbent in the US last year. That is the ultimate underlying issue, and I think from that perspective, our interests are aligned. Clearly, President Trump believes and has said that there are benefits from the trade measures, the tariffs that he's putting in place. He thinks there's reshoring benefits for the US economy, and he thinks there's benefits from leveling the playing field. And as disruptive as these have been, I am of the view that there are also benefits. I think if you look what has happened in Europe as a result of what President Trump has done so far, the fact that Europe has been motivated, not entirely voluntarily, to be more responsible about its own defense, that Germany has been put in a position to amend its constitution to allow the government to finance the investment necessary for defense, but also for investment in infrastructure and other areas, is an absolute positive. It will be positive for Germany. It will be positive for Europe. It will be positive for companies doing industrial business in Europe, and it will also be positive for companies involved in providing products and services to consumers in Europe, and we have plenty of those, as you know and as you can see here. Likewise, if part of the issue is to create a more level playing field for global trade, where, for example, the US has clearly deficits in terms of products, but it has services in terms of, surpluses in terms of services, in particular in Europe, then that is not the case in China. It is not the case in other countries in the world. So some degree of reciprocity, that word that President Trump has been using in connection with his tariffs, some degree of market opening and of leveling of playing fields, I think is also to be welcomed, because ultimately it should be business and competitiveness and other types of fundamental attributes that should decide capital allocation and where business is done. That is how the prosperity we've enjoyed has been created, and I think there's no question that that's also how it is going to be created going forward. So that's on the positives, I think, and that's effectively part of the framework. The next part of the framework is that clearly uncertainty is something that is of great value to President Trump. It's the art of the deal, and it puts the counterparty on the back foot. So the fact that uncertainty is going to be with us is simply a fact we're going to have to put up with for the time that President Trump is in office. At the same time, the approach clearly is around trial balloons, around making proposals and then seeing what the reaction is. But unlike some who expect those kinds of proposals to be thought through and negotiated and pre-agreed before they are disclosed in communiques and so forth, that is not President Trump's approach. His is clearly to make the proposal on Truth Social or whatever other platform, and then to see what happens. We've seen it across the board in geopolitics and macroeconomics, and to a significant degree, we've already seen it with the tariff announcement, which have clearly changed in a way that is dizzying for those of us who are analysts and who are trying to quantify their impact in terms of what is going on. So we need these frameworks and this understanding. And so with that, I think the third point is then what kind of company can prevail in that kind of environment. And we think that's where quality absolutely matters. Our global leaders are in a strong position to be able to weather this kind of uncertainty in the same way that they were able to weather, broadly speaking, the global financial crisis, in the way that they were able to weather the period of the pandemic, in the way that they were able to weather the period of extraordinary high inflation and normalization of interest rates. They're able to adapt, they're able to use their scale to invest, to realign their supply chains, to potentially buy other companies who have greater struggles, and they come out of these periods stronger. And we believe the same will be true for the companies that we invest in this period of high uncertainty. So I think that's the third point. The fourth point, I think, is in looking at the actual impact. And we're going to go into some examples right now, but I want to share the framework for that as well, which is what percentage of revenues do these companies, the first order impact, what percentage of revenues do these companies generate? In the US, what percentage of those is imported? And therefore, what are the tariffs that are currently in place? What are the tariffs that are likely to be in place going forward? Taking into account, of course, the exemptions and other measures that have already been part of what has been going on. And that's what we've done in particular. If you look at this image here, we've grouped just some of the companies, but to share the framework in terms of what we think the impact is. And as you can see, for the most part, we think it's lower medium. And where it's high, it's mostly because it's related to effectively more of the geopolitical considerations, like with NVIDIA, than it is with others. We will go into that in just a second about why we believe that. But in aggregate, we think that the impact on our stocks from that perspective, the first order impact, will be low or moderate. The second order impact, which is the question on what it's going to do to the economy, of course, is quite different. And I'll talk about that, I think, after we've had a chance to go through the impact that we see in some of the stocks that we've been invested in. But I think the final and fourth point is really related to this question of the art of the deal and some of the concessions significant that we've seen President Trump make. But let's talk about some of the stocks. And so the first one I want to talk about is Abbott. You've seen the strong performance. It's a US-based global leader in broadly healthcare and pharmaceuticals, in nutrition, in diagnostics, and in other areas. About 39% of the sales are in the US. The tariff impact on their cost of goods in 2025 is going to be $300 million. That's a 2% impact on the gross profit and a 3% impact on the operating income. So I think very important as we keep all of this into perspective. They have different means of mitigating the risks. They can adapt their global manufacturing footprint because of their scale. They've got 90 sites. They can optimize their supply chain. And one of the benefits, I think, that clearly may come from the US from all of this is they've decided to invest $500 million in expanding their plants in the US, part of the inbound investment, effectively, whether it's from US companies or from ones based elsewhere, that President Trump is looking to achieve, and that is likely to take place. And interestingly, as they've given their guidance for the after the first quarter numbers, the results were better than expected. They maintained their full year guidance and said clearly that excluding the impact of tariffs, which for them on the one hand is this primary impact, but it's also about the secondary impact, they would have in fact raised their 2025 guidance. Let's talk about a European company, L'Oreal, the global #1 in cosmetics, a company we think is very attractively positioned and at great valuation now. About 25% of the sales are in the US, of which 50% are manufactured there, 30% imported from Europe, that are now subject to a 10% tariff. 20% are from Mexico and Canada, where there's an exemption in place. So again, the impact on it is going to be moderate. They're going to increase prices because they've got pricing power, and they're going to move more production into the US. So again, there will be an impact, but it can be offset by the actions that the company can take. And so they, after the Q1 outlook they've given just now, gave a broadly confident outlook. They're gaining share because of what they do and their scale, and they've seen and they're expecting an acceleration in sales in the second half. So again, moderate and at the very least resilient. Sika, the Swiss company, we've talked about it a lot. It's a global leader in material technology. It is very well positioned. Last time we spoke to the CEO, he was very positive about the US. He was very positive about Europe and especially Germany, even before the announcements about the constitutional change and the investment that the government is now going to be undertaking, and positive about China and Japan in terms of the potential for turnaround and ongoing investment. 23% of sales are in the US, and it's almost 100% produced locally. Those of you who followed us for a while know that Sika is a very decentralized company, not just from a management perspective, but also from the way that it is set up. It has over 400 factories in over 100 countries. And that is because what they do is absolutely critical for the construction and other applications that they're going into. But at the same time, it is moderate in cost compared to the overall cost, high margin, but can't be in fact shipped for very long because of the nature of what it is. And so it's a strong competitive position for them. But it also means that they have a limited need to change their business model because their impact from these tariffs is going to be low. They recently confirmed their outlook for the year. They're expecting actually higher sales in constant currencies. That's despite reporting in Swiss francs, by the way, and higher margins, and confirmed the 2028 targets while acknowledging market uncertainty. So again, we need to see what happens, but they so far believe that their business is resilient. So the first order impacts will be moderate, and the second order impacts, of course, will depend on what President Trump actually ends up doing. And then finally, NVIDIA, a large position, one of our most successful ones. We've put here some screenshots about the disclosures about the latest Rubin chip, the one that's going to succeed the Blackwell. Those are screenshots from a presentation that Jensen Huang gave. We couldn't find better ones. That's why they look a little bit wonky here on the page, but they're clearly going to provide another major step up in terms of the capabilities of these chips. 47% of the sales are in the US. The primary chip supplier is obviously TSMC. So from that perspective, in principle, that's why we've classified it, the tariff exposure is high, except President Trump has exempted them because they're so important to the US economy. So it's absolutely critical. Meanwhile, TSMC's production to some extent is vertically integrated into China. So who knows what that is going to end up meaning, depending on what kind of deals are made. So we clearly are concerned and alert to these issues, but we think that they can be mitigated. The performance in NVIDIA, I think, comes on the one hand from the fact that they've been blocked from selling the H20 chip to China. How much of that is an actual concern? How much of it is another negotiation, effectively balloon, that's been put in place towards some kind of eventual negotiation with China around trade and around market access? Who knows? But that's what took the stock down. As you can see, it's about 12 billion of revenues in 2026. That's 6% of NVIDIA's total. That is unfortunate. It would be much better if they were able to produce and ship them. But again, it's something to keep in perspective as we look at a company that is going to be absolutely critical to the computing capacity that we need in order to take advantage of the data that we're amassing, and that is going to lead to productivity and efficiency and other types of benefits as we move forward. So I think that's important. And I think one of the things we want to highlight here as well in terms of the benefits that may flow from this is the 65 billion commitment that TSMC has added to an overall commitment of 165 billion of investment in fabs in the US. So clearly one of the things that President Trump has been looking for, the motion towards diversifying the global semiconductor supply chain has been ongoing. And so that's a good thing. It'll be good for the US economy. It'll be good for the resilience of the overall semiconductor supply chain. It'll be good for TSMC. And so I think it's one of the impacts that may be positive, and we think that the strong demand for the Blackwell may well be offsetting very soon these issues with the H20. So on NVIDIA as well, the reason why we are overall constructive in terms of the impact and the outlook. So then that's what giving you just 4 examples of then first of all the framework and then how we apply it. The outlook is it's going to be 100 days on 30th April. President Trump has clearly flooded the zone, as they said, and so this uncertainty is going to be with us. The impact of the tariffs is clearly so far negative in terms of the near-term outlook, in terms of the consumer confidence, in terms of the savings rate that is increased, and in terms of the corporate decision-making and the investment. It clearly is also leading to delays and to bottlenecking in terms of shipments. So even regardless of how quickly it gets resolved, there surely will be a 3 to 6 month period at minimum in which there will be pandemic-type disruptions because companies will have shipped inventory in the first quarter to be able to sell in the US. They will now be selling that, so there's effectively a buffer zone, and the question of if and when it gets resolved will depend, because if it gets resolved at a time when inventories in the US are exhausted, then there could be issues on both sides, the available supply, at the same time as there could be issues around demand, although the demand may come back a lot faster, depending how quickly these issues are resolved. So that's been one of the impacts. The second impact, I think, is important, is clearly the macroeconomic one in terms of the US dollar and the bond market. The currency has clearly declined massively, in part, I think, anticipation of the lower growth and of the potential for interest rate cuts. Inflation is also going to be clearly an issue that could prevent the Fed from acting. So I think that is one of the key issues, and it's been a very significant move. It will increase US competitiveness. It will also increase on exports. It will increase inflation. But it is a very notable reaction that has taken place that I think that we've all seen. It's also the question of the bond market and the reaction that took place with these extreme trial balloons that President Trump has set off. In particular, when we've seen that when the market reacted very strongly, as it has twice already, it has also led to an immediate reaction where he has taken back what he said. And we have the most recent statements. We've had it here. We've sort of said it's the art of the deal. He's said as recently as this week that tariffs from China will come down substantially, although they won't be zero. And there's no intention, after all, to sack US Fed Chairman Jerome Powell. So I think you have these statements looking to calm markets, but some realization that in the way that he goes about these things, he can also go too far. So it's clear that trade deals are under discussion. Again, with Mexico and Canada, they've been already part suspended. With Europe, they're at 10%. With China, there are discussions and clearly a desire to get into some kind of an agreement. And so I think for us, we have to keep the perspective on it. The central banks, depending on what inflation does, clearly have the scope to be supportive. So there's also a lot of firepower, I think, from that perspective. But we've put our favorite cartoon here, where we say that everything may be okay, although some people might think that's a lunatic view. We continue to believe that because we think that with the strong underlying fundamentals that the US economy has started with this year, in terms of the growth, in terms of the employment, and in terms of the perspective for lower inflation, and with the desire overall and the alignment around these, the goal of delivering a stable economy, lower prices, and also positive markets, and with what we're seeing in terms of the deal making that is taking place and that is responding to some of the significant pressures that in particular the bond market has placed on it. We think that we should have a constructive outlook going forward, because for us, it's about the fundamentals, it's about the quality, it's about real companies providing real goods and real services to real people, generating real revenues that turn into real cash, that are then able to generate real returns for the real institutions and individuals for whom we manage money. I think that is the basic conviction, and that is also what gives us the confidence to have a constructive outlook, and combined with the approach, with I think the performance and the portfolio position I've highlighted, to say that we think that we're also that these types of periods are periods of opportunity for us in absolute and also in relative performance terms. So just want to end simply in saying it's about the resilience, it's about the attractive industries and the structural growth, it's about the competitive positions and the lower leverage and the higher growth that our positioning allows us to incorporate into the portfolio. And that's what gives us the confidence in this very challenging environment as we're trying to understand it and to take the best advantage of the opportunities that we find.